Hi, my name is Dominic Tamaro, and I'm the Vice Chair for Education in the Department of Medicine at the Alpert Medical School at Brown University in Providence, Rhode Island. Today's module is one of the most important for people to understand, and that's on the basics of taxes. It is also the one that I find the most difficult to understand. So in my mind, this is one of the more important of the sessions that exist within this curriculum. So thank you again for joining us. What we're going to do is try to balance the big picture about understanding taxation and what you as an individual, a physician, a clinician may be facing as you understand taxes with some of the details. You need to know the details, but it's really more important to understand the big picture. So we're going to balance along the way, and we're going to start by going through some of the forms. We're going to get those definitions out of the way, so this way the rest of our discussion will flow more easily.
Hi, I am Lori Dubois, a CPA. I'm at Conlett Renza in Providence, and I'm a tax shareholder. So one of the first forms that you might see is a 1099 NEC. So that's a form that would be issued to you if you were moonlighting or doing anything as an independent contractor. New for 2026, you would receive that form if you received compensation of $2,000 or more. That form would be sent to you by January 31st each year, and you would have to pick it up on your individual income tax return. So that's the first form that you may receive. You may receive also a 1099 INT, which that is anything for relating to interest. So if a financial institution, if you have a bank account that has investment income, you might receive that form at year end as well. That you would also have to record on your personal income tax return. And that goes out for any interest income you receive over $10 in a calendar year. Form W-4, that's the first form that you will be asked to fill out when you start employment. That is where you figure out what you want to have withheld from your wages. That's going to determine the federal tax brackets that you're going to be in the withholding that you would have on your W-2 form. So that you would just fill out whether it's you're single, married, filing jointly, if you have dependents, that'll all go into play when you're filling out that form. Okay. And the last form is really the W-2 form. And that's when you are an employee. That's going to show basically your gross wages that you receive during the calendar year. It's going to show all of your withholding, federal and state, as well as Social Security and Medicare as well. And we'll go into that in a little more detail.
So the 1099s are records of what you have earned, what Correct. You've taken in. The W-4 is something that you complete at the beginning of employment that's going to tell your employer how much tax to take out of your salary.
Exactly.
Based on kids, married, filing jointly, those sorts of things.
Exactly, correct.
And then the W-2 you get annually. That's kind of a summary of what you've earned and paid in taxes already for the preceding year.
Exactly, okay. Correct.
So yes. those are really the four key pieces of information that you're going to get physical pay or electronic copies of those things.
Right, correct.
Okay.
And those will all be going into what you use for your tax return. So on the W-4, as I mentioned, you're going to get that right when you start employment. And it's a basic form, name, address, social security number. And you're going to basically be saying if you're single, married, filing jointly. Also, if you have other dependents, you would, show that as well. Or if you have multiple jobs, you can indicate that. A lot of people just keep it simple and just, record whether they're single, married, and then sign the form. And then your employer will take it from there and start withholding accordingly. And that can always be changed as the year goes on. If you think you have too much withholding or not enough, you could always make those changes during the year. And so the W-2 form, which you would see, is going to be a complete summary of everything that you earned during the year. So, box 1 always will show your gross taxable wages. Box 2 is basically going to be the federal income tax that you had withheld during the year. And then it's going to also show your Social Security and Medicare wages. So the difference there is, so for Social Security, you're going to be taxed on 6.2% of your Social Security income. So that is going to be a tax right off the bat for, that's going to go to the Social Security system. And the cap on that is the first about 184,000 of wages.
Let's back up just for a sec, because I think when you explained that, it made it sound like you pay 6.2% of your salary as a tax to build up Social Security for when you retire, when you get older.
Right, exactly.
Okay.
So on your wages, you will have withholding of 6.2% that is going to go directly to the Social Security system for when you retire. So a lot of people don't really realize that as they start employment, that they have this big tax withheld and they have less of a take-home pay because you're paying into Social Security and then you're also paying into Medicare. So that is another 1.45% on your total gross wages. And that does not have a cap on it, so you just pay an additional 1.45% on all of your wages, and that goes to the Medicare system.
You're describing the W-2 form by box numbers, box 1, box 2. Do those box numbers have any significance when you file your taxes each year?
Yes, yep, definitely. So, when you do file your taxes, whether you're doing it yourself on TurboTax or doing it with a tax professional, those boxes are going to be determined what goes on your Form 1040, which is what you actually file to do your taxes. So box 1, wages, that's actually going to be what's taxable to you for federal and state income taxes. And then it kind of goes down the line. Social Security and the Medicare taxes are kind of a given. They're already taxed, so they wouldn't go on the form really again because you've already been taxed on that. And then some of the other boxes, which we would get into for the non-taxable benefits, like if you're doing a 401k or the insurance premiums that you pay to take out of your pay, those will come out as pre-tax deductions, so you don't really have to pay taxes on that, but that would already be reduced from your box 1 wages. Other things on there is box 10, which is like dependent care deductions. So that is basically when you have, if you have a dependent or a child that you're putting through daycare and both spouses are working and have earned income, you can elect to put up to $7,500 towards your daycare bills, or it could be after school care or camps, whatever it may be. And that is usually a program that your employer would let you, take place in. And up to $7,500 would be tax-free, would come out pre-tax and go towards those benefits if you're paying them anyway.
So that amount isn't taxed, and by taking it out, that reduces my overall salary that is subjected to tax. So that reduces my overall taxes, and then this amount itself doesn't get taxed.
Exactly,
Okay.
Right.
Starting with a new employer and meeting with the HR department, they'll talk a lot about things that are pre-tax, contributions that you could make that are pre-tax, some for health insurance, charitable contributions, and things like that. Can you talk about some of the things that might be part of my overall compensation that are not taxed or pre-tax, and how I should regard those?
So if you are paying anything for your own health insurance premiums for yourself or your family, every employer would likely have, they call it a cafeteria plan. And that just means that if you are contributing to these things, then they will come out on a pre-tax basis to you, the employee. So you wouldn't have to pay tax on those. And that'll be reflected right on your W-2 itself.
So if I make $100 and I spend $20 of that $100 to pay for part of my health insurance, then the federal government or the state is only going to tax me on the $80 that remain, and that $20 is now free of tax. I don't have to pay any tax on that.
Correct.
Okay.
Right, exactly. And the other big one would be 401k or 403b, and those are retirement contributions that you would be contributing. So again, those would be non-taxable as you are contributing them. So basically what happens is, you contribute them, they go into your retirement account, and then you are not taxed on those until you start taking distributions out years down the road.
The difference between a traditional 401k and a Roth 401k, a little confusing to me. Can you outline that?
Sure. So a traditional 401k is going to be non-taxable as you put those contributions in. So as you contribute to that 401k, you will see an immediate deduction off of your gross wages. So you won't have to pay taxes on that on day one. Roth 401k or IRA is going to be a little different. You do not get a deduction immediately as you contribute to the 401k, but the difference is when you take distributions out, that Roth IRA or 401k, it is non-taxable to you down the road, nor the earnings are. Whereas the traditional 401k, yes, you got the deduction when you first contributed it, but then you're going to pay tax on it when you take distributions out when you retire.
So it's really the timing of when you're taxed.
Correct.
Right?
Right.
With the traditional, you're not taxed until you take the contribution out, so it's tax deferred. With the Roth, you're taxed when you put the money in, but then it grows tax-free. When you take it out, it's tax-free withdrawal as well.
There are limitations on who can use Roth 401ks and IRAs. So, it is good that if you qualify early on when your income is at a, not at a high net worth level, then, you might want to take advantage of doing that.
One of the choices that we have to make regarding health insurance is this health savings account, HSA, and a flexible spending account, FSA. And they both can be used for healthcare, but they're different. How are those treated with respect to taxes?
Sure. So a health savings account is when you have a high deductible plan, and there's certain limits on, what a high deductible plan is. But if you do qualify for that, you can contribute to a health savings account, and it's really your account. It's portable, and you can use the money, years down the road. It can accumulate, and the earnings would not be taxed as long as you use it for health purposes. And, that you can use, for many years down the road, whereas a flex spending account, again, it would not be taxed as you put those contributions in, but it's a use it or lose it scenario where it's basically not portable, so you have to usually use it by year end on medical expenses. That one is a little more, not as flexible, and you want to make sure that what you contribute to it each year, that you really plan on spending for medical expenses, because you wouldn't want to lose it.
Some residents, actually many residents, will moonlight outside of their training program. They'll work in an ER or an urgent care as an employee or as a contractor. Can you talk a little bit about how their salary, or not salary so much as their compensation, because sometimes they're paid just by shift, how is that taxed, and how would they see that at the end of the year?
So what ends up happening is, the employer will give them a 1099 NEC. And so that is basically non-employee compensation. And it'll just be for the gross amount. So if they earn $10,000 during the calendar year, they're going to receive a 1099 NEC by January 31st of the following year. They will have to pick that full income up on their personal income tax return, and it will be subject to same Social Security, Medicare, federal and state income taxes. Because you didn't have that withheld, it's almost like you are the employee and the employer. So you have to pay both portions of the Social Security and Medicare taxes. So it can, sometimes hit people that, you are paying a lot more taxes on that because you didn't have the withholding as if you would, as if it was a W-2. and you kind of should be prepared for that. I would say if you feel like you have a lot of moonlighting income, you might want to pay estimated taxes throughout the year, just so that you're not subject to any interest or penalties or things of that nature.
The amount that I would get if taxes aren't already withheld, if it's just that block amount, I'm going to have to pay taxes on that eventually when I file my tax return at the latest.
Exactly.
So
correct.
I shouldn't spend all that money on a new stereo system. I should put some in reserve for when I have to pay taxes.
Right, correct, definitely.
So many of the residents and fellows that are going to be watching and attendings that are going to be watching these videos have student loan debt.
Sure.
Can you talk about the tax implications of that debt?
Basically, in certain circumstances, you can deduct up to $2,500 worth of student loan debt, loan interest payments during the year. It's very limited because there are income caps that you have to go through to see if you qualify for the deduction. And they start to phase out once, income is over $85,000. So it's a low threshold for, a physician to be able to deduct those. So a lot of times, unfortunately, the interest does not get deducted.
So we have some questions now that I've heard and other residents in discussions have offered up as things that they would want to ask an accountant so that they can prepare for when they have to pay taxes. So maybe we'll just go through those,
Sure.
those questions. To start off with, comes time to do my taxes, where can I get some help? What are the different levels or the different places that I can get some help in doing taxes?
Sure. So, there are resources online, like, first you can do it yourself using a TurboTax or some type of software that kind of walks you through it. If it's pretty simple return where you just have W-2 income, that might be the most economical way to go. There are also, chains out there, the H&R Blocks and things like that, that if you need a little more assistance, you can go to as well, if you don't want to do that yourself and take that on. And there are CPA firms as well that if you need more assistance, you end up having more complex tax returns, you need someone to talk to either year-round or quarterly to help you out with planning, you can go there as well.
Then another question that stems from this discussion then is, when I go to talk to an accountant or to a commercial tax preparation chain, what documents should I have with me? Throughout the year, what documents should I keep and hold on to help figure out how to file my taxes?
So you definitely want to keep all of yours, send them your W-2, anything W-2, 1099s, 1099 interest, the NECs like we talked about. And if you do have 1099 moonlighting income from the NECs, you're also going to want to keep track of any expenses that you have that can offset that income. So say, for instance, you are traveling and you have to, basically go from one hospital to another to produce this income. Those are deductible expenses against that income. So you're going to want to keep track of that, as well as if you, had to buy any equipment that went into producing that income, any medical equipment or supplies, you're going to want to keep track of that as well. And, we would take that into consideration to reduce your income and reduce that tax burden overall.
So for example, with that latter discussion, dermatologists will often use these highly precise dermatoscopes, which are lit up and they allow you to look in great detail very closely at the skin, and they can run thousands of dollars. So if someone bought one and paid for it out of pocket, what would they do? How would that be reflected in their tax return, say?
A W-2 employee only, and they were purchasing that for themselves. Unfortunately, that would not be deductible because it's really, we used to be able to have miscellaneous itemized deductions, which were unreimbursed employee expenses. those are no longer deductible. So in that circumstance, you would probably want to get your employer to reimburse you for that if you were just a W-2 employee. And so then you wouldn't be out of pocket that expense. But if you were doing it and it was used for moonlighting against a 1099 NEC that we just talked about, that you would be able to deduct fully on the Schedule C form. That's the form that you're going to fill out if you actually have moonlighting income. You would show the income, and then you would also show all the expenses that go against it so that we can, reduce the tax burden as much as possible.
And so deduction really means expenses that reduce the tax burden.
Exactly.
Okay. What about membership in professional organizations? Is that something I can deduct?
So if it's just a membership and you are a W-2 employee, it's not really going to be deductible. So you're going to want to try to get your employer to reimburse you for that if it is really, a necessary expense. But if you do have that 1099 NEC income similar to the equipment that you're purchasing, that would be a deduction.
So those expense deductions really apply if I'm an independent contractor or self-employed, not if I'm an employee of another organization.
Correct. Right.
Okay.
That's right.
So I've been working for a few years. My stacks of past tax returns are piling up. How long should I be keeping these things?
Good question. So really the IRS and the states have 3 years to go back and audit you generally if from when you did your last tax return. So you're always going to want to keep probably 4 years worth of documentation because you wouldn't file your tax return until around April 15th of the following year. They would have, April 15th from 3 years from now to audit you. So any large purchases, like if you're purchasing a home, anything like that, you're going to want to keep those records, indefinitely. You're going to have some things that are going to be permanent records, including, major improvements on your home, as well as the actual purchase of it, just so that when you go to sell the house, that's all going to be used for, basis down the road and, would show how much your, true cost of the house would be. Some things would need to be kept permanently, but the normal things like W-2s, 1099s, I would keep for 3 years past the filing date.
When should we be getting all these 1099s and W-2s? Tax filing day is generally April 15th. The year ends on December 31st. So there's the 3 or 4 months in between that I have to get my taxes ready.
Right.
When am I going to get all these forms?
Most of the forms will come to you by January 31st, with the exception if you have a lot of investment income with, some 1099s. If they're very complex, they're supposed to go out by January 31st, but the financial institutions give them an extension. So those sometimes come out in February. But most of the documents you should have, by the end of January is typical. And then you'd have until April 15th to file the tax return. If for some reason there isn't a piece of investment, some companies give out, if you're an investment in like a partnership or another S corporation, they will give you a form K1. Those K1s might not come to you by April 15th, so you might need to extend your tax return, and that's something that, some people need to do, and you would have until October 15th to file at that point. But if any taxes are due, you still need to estimate that and pay them by April 15th.
So I've been really busy. I haven't gotten to this yet. I heard that you can ask for an extension. Is that going to hurt me? Is that going to count against my credit rating, or is it okay to ask for an extension?
Definitely okay to ask for an extension. The key there is that you still need to have all your taxes paid in by April 15th. So if you felt that you were going to owe money with your tax return, even though you don't have all the documentation to file it at that point, you could pay in the money with an extension on April 15th, and then you'd have until October 15th of that year to actually file and, get the accurate information to file your tax return.
And if I overpaid on my estimate, I would get that difference back?
Yes, you would get that back as a refund, or sometimes if, you could do it as an overpayment applied to the next year, if you had consulting income and things like that that you wanted to apply to the next year.
Is there anything else in your experience that someone just starting out in their careers would benefit from knowing as it pertains to taxes?
I think the biggest thing sometimes that people don't understand is, if they are moonlighting and they're getting that 1099 income, that 1099 NEC income. With the W-2, it's a little easier because you have federal and state withholding on it and Social Security and Medicare. So you're getting less of a net take-home pay. But I think a lot of times people don't realize when they are moonlighting and they have to pick up all that income in a given year, it adds up, and then come April you have to basically pay the taxes on that. So I think that sometimes gets people off guard. Other than that, it's just really collecting the data as you go along. Another example is whether you take the standard deduction versus itemizing. That's going to be a year-by-year test on whichever one is higher. The standard deduction is quite high right now. So what goes into itemizing is if you own a home, if you have mortgage interest, so that could be a deduction. Your state and local taxes that you pay on your personal tax return, as well as your real estate taxes. It has been capped at $10,000 for the last few years. That cap is now $40,000, but it's also income limitations on that as well. But definitely, I would say a new physician should be able to, take advantage of the full, state and local tax deduction, the mortgage interest, as well as charitable donations.
And so those are all things that, if I list them and itemize them on my tax return, would count against my income and reduce my taxes.
Exactly.
If I don't think I have a lot of those things to list, then I can just take the standard deduction, which you said at this point is very high, because all those itemized things won't add up to more than the standard deduction.
Right,
okay.
Correct, exactly.
Right. So one other question that comes up from time to time is, my parents gave me a few $1,000s to help me buy a car. Does that count with respect to taxes? How is that treated from a tax standpoint?
Gifts are generally not taxable to the recipient itself, so you would not have to pick that up on your income tax return. The donor or whoever is giving that gift, they may have to file a gift tax return if the amount is over $19,000. Each person can give a single individual up to $19,000 per year as a gift exclusion and not have to file a tax return. You can gift split, so if mom and dad both wanted to give you $19,000, you can get up to $38,000 and they wouldn't have to file a gift tax return. Even if they filed a gift tax return, it's just really, it goes against their lifetime gifting, which is very high right now with the new tax law. But so it's not like they'd have to pay income taxes on it. It's just more of reporting and tracking on how much gifts they've given out through the years.
So there's no tax liability to me for receiving that gift, and because it's much lower than the $19,000, there's no tax liability to them.
Correct. Exactly.
Okay. So that'll wrap this session up on the basics of taxation. It's a complicated area, and I encourage you to think in a detailed way about preparing for being taxed. It's a reality that everyone has to deal with, and it's great to have someone knowledgeable to help with the process. So thank you for your attention, and we hope that you found this helpful and informative.